So the
Mwalimu,
capital, yes,
nikwambia niko kwa matanga ingine hapa. See you continue. I join you in a few.
no problem.
Then you'll send for me videos.
Okay,
But I'm following. I'm not leaving.
no problem. So capital structure theories. Capital structure theories. We have the theories that explain the effects. So these ones, most importantly, they explain the effect of debt financing, the effect of debt financing to the value and WSEC of a firm. How does debt affect the value and how does debt affect the WSEC of a firm? And they have assumptions for the capital structure theories to hold. Some assumptions must apply. One of the assumptions is that preference shares do not exist. Preference shares do not exist. So debt, the firm can only be financed by debt and equity. We have debt is always cheaper than equity. And that is considered to be cheaper than equity because of the assumptions that or because of the effect of debt. When the company has debt, those who gave the company debt are given priority upon liquidation of the company, and that makes it less risky. And when it is less risky, even the investors in debt will demand a lower return. That makes it cheaper. So the lower the risk, the lower the return. The return is the cost to the company as it's an income to the investor. The second reason as trade debt is considered to be cheaper is because of the tax effect on debt. The tax effect on debt reduces the cost. So another assumption, payout ratio is 100%. Payout ratio is 100%. So all profits are paid out as dividends. Nothing is retained in the company for investment. Dividends, another one. Dividends and earnings do not grow. Most importantly, G equals to 0. Dividends and earnings do not grow. Of course, we have some others that some firms pay taxes, others do not. So we have different types of capital structure theories. We have traditional theory. After the traditional theory, we have others. The net income approach, that is NI. We have net operating income approach, that is NOI. And finally, number D, we have Modigliani and Miller, that is MM approaches. Under the MM, kona ya kwanza ambayo ni MM1. MM1 ambayo inasema no taxes, with no taxes. We have MM2 ambayo inasema with corporate taxes. we have MM3 ambayo inasema with corporate and personal taxes and finally we have MM4 inasema with corporate taxes and financial distress costs. So those are the capital structure theories. Now, what should guide us to start with is that we need to get the value of the firm and the WSEC. Anytime you're talking about value, let me start with the WSEC. We know that tumesema kuwa debt does not exist. So WSEC is going to be the weight of equity times cost of equity plus the weight of debt times the cost of debt. And the cost of debt, kama tuko na tax, it must be the after-tax cost of debt. So that gives us the WSEC, weight of equity, cost of equity, weight of debt, cost of debt. From the WSEC perspective, we know that cost of equity equals to D1. D1, of course, we divide by PO. We divide by the PO. Then we add the G. Let me put this PO huku ingine. So let me say, so here I have the PO. Then huku mbele tunaongeza our G. That makes sense. Great. Now, among the assumptions, hapa, especially the last two, payout ratios are 100%, dividends and earnings do not grow. From our assumption number 4, it confirms that G equals to 0. And also, profit after tax is the same as the dividends. The D1. And of course, let this PO to replace to it the market value. A value of equity. Let's call it value of equity, that is VE. So PO, we replace it with the VE. With that one, I believe we can appreciate that the cost of equity would be equals to profit after tax, just the same as the dividends. And we divide that one by the value of equity. I hope that makes some sense. Because the dividends are the same as the profit after tax, that is our D1, and G equals to 0. PO, we are replacing it to be value of equity, VE. And sometimes examiner anatunyima the PAT, anatupa the EBIT. Hizi basics ndo tukizielewa, capital structures zita make a lot of sense. If we start from earnings before interest and tax, which is the same as operating profit. the same as operating profit. If we start from there, we are supposed to less, now preparing the income statement, you're supposed to less the interest. Is the interest profit before interest? So less the interest. And that one gives us profit before tax. We less tax. We less tax. And now we get our profit after tax. That gives us the profit after tax. Hiyo ndo concept inafai to guide. Now, with this one, if we start with the net income approach, hii traditional theory, hizo ni theory, juu ina hesabu. That one, if I've not shared the notes, remind me I share. Tuzipitie. Pecking order. Have I shared the notes on traditional theory?
Yeah, I think I have them.
Okay.
Okay.
So the net income approach, the NI. The fundamental assumptions about the NI is that no taxes exist. Very important. And as you're looking at that, we're just asking ourselves, how does debt affect the value and the WS? So we need to compare the value of the firm and the WSEC for a company that is all equity financed with the value and the WSC for a company that is financed partly by debt and partly by equity. So here we shall have unlevered firm, then maybe about a levered firm. Levered ama geared. We know that unlevered is all equity financed. Levered firm is financed by both debt and equity. And this one is financed by equity only. So the WSEC, sorry. So we need to get the WSEC. For the unlevered firm, based on our formula here, our WSEC, because there is no debt, the WSEC of the unlevered firm will simply be the cost of equity. The weight of equity will be 100%. So I don't need to do cost times 1. Because, sorry, because it's 100% equity. So our WSEC here is the cost of equity of the unlevered firm. Cost of equity of unlevered firm. And the cost of equity of unlevered firm, from where we have, is the PAT over value of equity. So this one equals to PAT divided by the value of equity of unlevered firm. Now, if I've been given EBIT and I want to reach the PAT, if the firm is unlevered, for instance, if EBIT is maybe 100 million, the firm is unlevered, meaning it has no interest, so interest will be 0. There's no debt. The profit before tax shall be 100 million. Then we less tax. The assumption of net income, no taxes exist. So meaning our tax will also be 0. So that means our profit after tax will remain to be 100 million. So what are you talking about here? That the cost of equity, the WSCC of unlevered farm is the same as its equity. It's the same as the cost of equity, which is the PAT over the value of equity. Na kama umepewa EBIT, it will be the same as, so cost of equity of unlevered will be equals to EBIT divided by value of equity of the unlevered farm. Because PAT na EBIT ni the same. Debt does not exist, so there is no interest. Net income taxes do not exist, so hapo itabaki 0. Then for the levered farm, the WSCC would be equals to weight of equity times cost of equity plus weight of debt times cost of debt. Taxes do not exist. Of course, our cost of equity of the levered farm, our concept does not change. Profit after tax divided by the value of equity of the levered. And I believe that from this question, from this working of ours, sasa levered farm iko na interest. So if I have EBIT of like 100 million, I'm supposed to less interest. If interest is maybe of 10 million, then that means my profit before tax will be 90 million. Taxes do not exist, tax ni 0. Profit after tax tabaki 90 million. So what do we mean by this? We mean that this PAT, the cost of equity, we are here. The cost of equity of the levered can also be the same as EBIT with less interest. EBIT with less interest. And we divide everything by value of equity. Hivyo tu. That's the cost of equity, this one. Of course, KD equals to interest rate. Interest rate, if it's selling at par. Alternatively, KD can be equals to interest divided by value of debt. Taxes do not exist, remember? So I need to get the values now. Remember our introduction tulisema kuwa they explain the effect of debt financing to the value and WSCC. So look at the WSCC of the farm without debt and the WSCC of the farm with debt. So I also need to know the value of the farm without debt and the value of the farm with debt. So look at the value of farm. So for the unlevered farm, value of the unlevered farm is the same as the value of equity of unlevered farm. From here, I can make value of equity the subject I think it will be, if we make value the subject, I'm saying it will be EBIT divided by cost of equity of unlevered. If you're using the profit after tax divided by the cost of equity. And I think if somebody else put it this way, as a profit after tax divided by WSCC of unlevered, it should not confuse us. Because I know the WSC of unlevered is the same as the cost of equity. Now, alternatively, value of unlevered farm is the same as the value of equity of unlevered farm, which equals to number of shares, number of ordinary shares, we multiply by the market price per share, the value of equity. So you can either use this formula or you can use this depending on information provided. So that is for the value. Then on this other side, the value of the delivered farm. So this one equals to value of equity of the delivered plus value of debt. So delivered farm iko na debt na iko na equity. Value of equity, we can get it from this formula, making val the subject, hii inakuja huku, hii kuja hapa. EBIT minus interest over the cost of equity. So value of equity of the delivered equals to EBIT with less interest, and we divide everything by the cost of equity. Alternatively, the value of equity of the delivered farm will be the number of shares we multiply by the price per share. Then the value of debt is simply the market value of the debt. The number of debentures times the price per debenture. So this one is about the market value of the debentures. Good. So those formulas must guide us. Na hizi ndo that guide kwa net income approach, net operating income, MM1, MM2, MM3, pia hata MM3 na MM4 zote. Bora tujue kuwa under net income approach, let me go back up a little bit. Under net income approach here, no taxes. No taxes. Even the net operating income, it also says there are no taxes. no taxes.
Excuse me, mwalimu.
Yes.
Kindly back scroll up. I take a screenshot. Kindly just scroll up where you started. I take a screenshot. Okay, it's okay.
That's okay.
Yeah, that's okay.
So we've just been saying that the net income approach appreciates that there are no taxes. The net operating income approach also appreciates that no taxes, although this one is a little bit different. No taxes and debt has no effect on the value or WLCC. MM1, this one is similar to NOI. So as we'll be doing questions on NOI, we'll also be replicating the MM1. Then of course, MM2, there's some corporation taxes. MM3, there's some corporation and personal taxes. MM4, hizi za tatu za mwisho, zote ziko na taxes. So let's now continue. So that is about the NI, net income approach. Taxes do not exist. The WSE of unlevered farm is the cost of equity, which is EBIT over value of equity. The value of the unlevered farm is the value of equity, which is EBIT over cost of equity of unlevered, or it can be EBIT over the WSEC. Or we use the number of shares times the price per share. Levered farm tuko nayo hapo. Sorry. If we go to, can we go to NOI?
Just yeah, no, kindly only 5 minutes. I copy these things. The levered farm, part of the levered farm.
Okay. So for the net operating income approach, this one, it states that debt has no effect on value, on both the value and WSEC of a firm in absence of taxes. So yes, it also says that taxes do not exist, and in absence of taxes, debt will not affect the value or WSEC. And just as I said, so that I don't forget, that NOI is the same as the MM1. MM1. Yenye nasema without taxes. So debt has no effect on the value or WSEC of the firm. And for that reason, the value of the levered firm is the same as the value of unlevered firm, which is calculated using EBIT divided by WSEC. Hivyo tu. Of course, WSEC of the levered firm also equals WSEC of unlevered firm. Hivyo tuna net operating income inaisha. Then net operating income is the same as the MM1. When you go to MM2, MM2 inasema wakati tuko na corporation taxes. So kwa corporation taxes, so this one inasema kuwa everything originates from unlevered farm. So if we start with the unlevered, so hapa tuko na unlevered again. Levered tutaweka huku mbele tena. So for the unlevered farm, inasema kuwa the value of unlevered farm, of course, is the same as the value of equity of unlevered, which equals to EBIT. Fortunately, now this time round, chaturudi hapa juu kidogo, we relate. This time round now we are here now. This time round we have taxes. Unlevered farm, of course, it has no interest. Kwa hivyo interest itakuwa 0, but taxes ziko hapa, so tax will not be 0. Tax maybe tax rate of 30%, meaning our tax will be 30% of 100, 30 million. Our profit after tax will be 70 million. So ili ufikie the 70 million, I believe you can take the EBIT. If tax is 30%, you adjust for tax. 1 minus T. So 1 minus 0.3, we get the 70. So what am I driving at here? I'm driving at a point where we need to appreciate kuwa the value of unlevered, it will be EBIT. We adjust for tax, 1 minus T. And everything we divide by the cost of equity of unlevered. So there we go.
Mwalimu, in this
Yes.
EBIT, are we not placing the interest? EBIT minus interest, 1
Now
minus T.
Now the unlevered
Oh,
farm
unlevered
has no
haina
debt.
hizi.
Unlevered has no debt. Even if you less interest, the interest will be 0, right? Good. Alternatively, number of ordinary shares, you multiply by the market price per share. Number of ordinary shares, you multiply by the market price per share. That should give us the value of unlevered farm. The value of equity is the number of shares. So let me put it here alternatively. So here, value of equity of unlevered farm will be the same, will be equals to number of ordinary shares times the price per share. And of course, WSCC of unlevered farm equals to cost of equity of unlevered. We can make it the subject here. EBIT 1 minus T. Then we divide by VEU. So there we go. That is the WSCC for the unlevered farm. Tukienda kwa levered, inasema kuwa value of the levered farm equals value of unlevered plus the value of debt times tax shield times tax rate times tax rate. This one here is known as tax shield on total debt. Tax shield on total debt. Hii ya mbele, the VD times tax rate. The another name is tax shield on total debt. That's how we get the value of the levered farm under MM2. Now, where confusion comes from, and maybe you can attest this to me, is that each theory iko na approach yake. You can see the net income approach, the value of the levered farm was the value of equity plus the value of debt. Huku nako tunasema value of the levered farm is the value of unlevered plus the tax on debt. So every theory has its own approach. That's the challenge. Hapo ndo penye huwa inasumbulia. Then WSCC of the levered farm, of course, equals to weight of equity, cost of equity, plus weight of debt, cost of debt, and the cost of debt we must have adjusted for tax. So where the challenge comes in, inakwanga kupata hii cost of equity ya hapa tu. Cost of equity of the levered farm. Hiyo tu ndio kusumbua. And this one equals to cost of equity of unlevered. Then we add risk premium. Risk premium. How do you get risk premium? Risk premium equals to the people I asked risk premium wakaniambia ni RM minus RF.
Risk premium is equals to cost of equity of unlevered farm minus cost of debt.
So take the cost of equity of unlevered.
Yes,
minus,
then you minus cost of debt.
We multiply by the proportions of debt to equity. So debt over
equity, then we adjust for tax.
We adjust for tax. So which means that the cost of equity of the levered farm, so that one is going to be the cost of equity of unlevered plus risk premium, which is the KU minus KD. KU minus KD. KU minus KD. Then times debt over equity. We adjust for tax. Na tutakuwa tumemaliza hiyo MM2. Then of course, we can summarize MM3 and MM4. With that summary, we can now go to the questions. So MM3. Hii inasema with corporation and personal taxes. So it's an improvement. So this one, it is a continuation of MM2. Na hii inasema kuwa for unlevered farm, the value of unlevered farm, of course, equals the value of equity. It's all equity financed, which equals to EBIT. Hakuna debt. So we adjust for the corporation tax, 1 minus corporation tax. So it's affected by two types of taxes. Unlevered farm iko na debt na iko na equity. Sorry, unlevered farm haina debt. So as it is paying the corporation tax, it will also pay the tax on stock, tax on equity. Tax on equity will arise because of the dividends that we pay. So shall also have 1 minus TS. TS standing for the tax on stock. Stock is equity. And everything we divide by the value, the cost of equity, sorry. So we divide by the cost of equity of the unlevered farm. So of course, where TS is the tax on stock, your T in corporation tax, it will be affected by two types of taxes, corporation tax and the tax on stock. Corporation tax and the tax on stock. Then for the WSEC of the unlevered farm is the same as the cost of equity of unlevered farm, which you can get it from here. We make it the subject of that equation. We have EBIT. We adjust for the corporation tax. We also adjust for the tax on personal stock. And everything we divide by, so we shall now divide by the value of equity of the unlevered farm. That is our WSEC. Then for the levered farm, the value of the levered farm, equals to value of unlevered, again, plus the tax shield on total debt. Kama tu ya MM2. But now here the tax shield on total debt is calculated a little bit different. It's calculated a little bit different. So here, tax shield on total debt. Tax shield on total debt equals to, so having the value of debt into, we have the big one minus, we have 1 minus the corporation tax, then 1 minus the tax on stock, And this everything hii ya huku mbele tuna divide by 1 minus the tax on debt. So hii 1 iko huku. So there we go. MM3 doesn't require us to calculate the WSEC for the levered farm. Then finally MM4. So this one has corporation tax and financial distress cost. So for the unlevered farm, this one, it is similar to MM2. Very similar to MM2. So MM2 is here. The value of unlevered farm equals to value of equity of unlevered farm, which equals to EBIT 1 minus the corporation tax. Then we divide by the cost of equity. Very similar to MM2. The cost will be the same. But now for the unlevered, for the levered farm, the value of the levered farm equals to value of unlevered plus the value of debt times tax rate. Paka hapo ni sawa na MM2, but now we subtract the present value of expected financial distress costs, expected future financial distress costs, present value of expected future financial distress costs. So to get the present value of expected future financial distress costs, we take the present value of future financial distress costs, we multiply by the probability that will be provided. So zote tutakuwa tumepewa. Na tumemaliza summary yetu. So our just hapa juu kidogo, the value of the levered farm with the value of unlevered plus this, the tax shield on total debt. Let's see if we can get a question. We need the formulas tumemaliza. Tumemaliza. Hi. Good. Acha tutoke kwa formulas, tutafute swali. So there's let's see. So last sitting it was tested. Sijui kama hiyo last sitting tulifanya.
Hiyo tulifanya, but we can still redo it.
Sawa. Hi. That is December 2023, question 1B. First of all, as we read the question, it's important to identify which capital structure theory it is, so that ikiwa NI, ujue taxes do not exist, but debt has an effect. Sorry, ikiwa MM1, which is the same as NOI, you also know how to approach it. So in a study carried out by a financial analyst, the earnings before interest and tax of Papa Limited and Kaka Limited was found to be 10 million. So that is our EBIT, 10 million. Papa is fully equity financed, while Kaka is financed partly using equity and debt. The capital structures of both firms are as follows. So you have Papa Limited equity, the market value is 100. Then Papa Limited has Kaka Limited, sorry. Kaka Limited has both equity of 70 and debt of 50 million. So the equity is the market value. Debt, the interest rate is 5% and it's trading at par. Both firms adopt 100% payout ratio. That was one of our assumptions. Debt does not, the payout ratio is 100%. Cost of equity of Papa Limited is 10%. Using Modigliani and Miller's proposition in absence of taxes. In absence of taxes, if we can refer to our workings, in absence of taxes was MM1. MM1 without taxes. And this is the information we have about MM1. Determine the cost of equity of Kaka Limited. So cost of equity of Kaka Limited. Kaka Limited iko hapa. So now cost of equity of the levered firm. We know that it will be EBIT minus interest. And remember, taxes do not exist. This is MM1. And we divide it by the value of equity. The value of equity of the unlevered. So do we have our EBIT in the question? So our EBIT in the question, is it 10 million?
Yes, 10 million.
So our EBIT in the question is 10 million. So you have 10 million here. 10 million. minus interest. Our interest rate is 5%. 5%. The cost of equity is ngapi? Sorry, the value of debt, is it 50 million?
50 million.
Minus 5% times 50 million. That gives us the interest. Then we divide by the value of equity. What is the value of equity? 70. So we divide by 70. So that gives us what percent? When you make it a percentage,
10.71.
10.79.
71. 71.
So 10.71. And that answers our part 1. Determine the cost of equity. Then part 2, comment on the equilibrium. Comment on the equilibrium position on the value of both firms, and hence show that the capital structure decision will have no effect on both the value of the firms and their WSCC. So comment on the equilibrium. Remember now, under MM1 or the NOI, the capital structure will not affect the value of the WSCC. So just as a point of equilibrium point is where the value and the WSCC of both firms will be equal. You're at that point of indifference. You're not able to decide whether to use debt or to ignore debt. So if you have to comment, you simply say that the point of equilibrium is where the value and WSCC of both firms will be equal. And let us show that the capital structure decisions will not affect.
Pardon, please. Pardon.
Yes. You're just saying that the point of equilibrium is like a point of indifference. Is the point where the value and WSCC of both firms will be equal. Where the value and WSCC of both firms will be equal. That's the point of equilibrium. That's fine. So let us confirm. Let us show that the capital structure decisions will have no effect on both the value and the WSCC. So we need before debt. So before debt, we start with Papa. Papa Limited. We know that value of Papa equals to value of equity, which equals to 100 million. Then you also know that WSCC of Papa is the same as the cost of equity of Papa. Do you have the cost of equity of Papa? 10%. That is for Papa. Then we go to Kaka. We go to Kaka. Na kukaka tunasema the value of kaka should be the same as the value of papa, which equals to EBIT over WSCC. This firm has EBIT. It has EBIT of 10. Hata huku tulifaa kufanya value of equity. Hii ni uongo. Hapa acha tu adjust. Tuko kwa MM1 or NOI. So value of papa equals to EBIT. Sorry for that. EBIT divided by the WSCC. So which equals to our EBIT, I can see it's 10 million divided by the WSCC of kaka is 10%, that is 0.1. So that is confirming our 100 million. Because WSCC yake ni 10%. So value of kaka is the same as the value of papa, ambayo tuko nayo pale juu ni shillings 100 million. Then WSCC of kaka, we know that equals to weight of equity, cost of equity, plus weight of debt, cost of debt. Of course, the value should be 100. By all means, the value of the farm, value of kaka. Yes, the 100 million must have a combination of equity and debt. Must have a combination of equity and debt. Debt value is trading at par. So the value of debt is 50 million. So therefore 100 million equals to value of debt ambayo ni 50 million. Then the value of equity ndo tunatafuta. So you have to assume, we have to find a new value of equity because the total value should be 100 million under MM1. Debt will always be there. Equity fluctuates depending on the market prices. So from that one, the value of equity.
Excuse me, Mwalimu.
Yes.
I think I'm lost. Is it not papa whose value is 100 million, not kaka? And you're writing kaka to be 100 million. I think I'm lost somewhere.
We are guided by the MM1. Turudi kwa MM1 tuone. MM1 tulisema nini? The value of unlevered farm, the value of the levered farm is the same as the value of unlevered farm, which is EBIT over WSCC. Where we say that debt has no effect on both the value and WSCC. So under MM1, the unlevered farm should have the same value as the levered farm. So once you have the value of the levered farm ambayo ni papa being 100 million, even the value of kaka should be the same as the value of papa ambayo ni 100. So this is now MM1. So this other figure here, the 70 million for equity, is meant to cause some confusion to us. But we must appreciate that the assumptions of MM1 must hold. Debt whether we have debt or we don't have debt, when the value of the farm without debt is 100, even the value of the farm with debt should also be 100, not 120 vile iko. But because debt is an obligation, you can't change it, you can vary the equity. Sawa. So that's why the value of the levered farm, the same as the value of unlevered farm, ambayo ni 100 million. So these 100 million being the value has debt of 50 million. So equity itakuwa the difference, which is how much is it? 50 also. So equity will be 50 million. So in that one, we need to get the cost of equity. Cost of equity. Cost of equity of the levered farm should be equals to. Now, let me just clarify something here. If I can remember how we were marking, how it was being marked, somebody who used 70 also got it right, because sasa hapa ilikuwa ilikuwa if issue yenye ilikuwa na examiner huko kwingine. So the cost of equity of the levered farm, sorry for that. Let me just try to clarify what I'm talking about. Kwa swali walituambia the equity is valued at 70. Somebody who uses it, who used it in the exam, although it was wrong to use it, but he was not punished for it because the examiner had provided us the equity nakaita and the market value. Because under MM1, in appreciate kuwa, there is no way a levered farm will have a different value compared to unlevered farm. When you do 70 plus 50, you get 120, and this one is 100. So under MM1, which is the same as NOI, if the unlevered farm is valued at 100, the levered farm should also be valued at 100. And that's why we're told, show that the capital structure decision will have no effect on both the value of the farms and their WSCC. So the value should remain the same. 100, 100. WSCC should also remain the same. 10%, 10%. And that's why hapa tunakuja tunakoroga kila kitu. So even the cost of equity of the levered farm will have to change. Will have to change, which equals to EBIT. We subtract the interest and we divide by the value of equity of the levered farm. So our EBIT was 10 million, if you can remember. Our interest rate is 5%. So 5% of the value of debt is 50 million. So 50. And everything we divide by the value of equity, which is also 50. So what do we have there? As a percentage, 10 minus 5% of 50 divided by 50. Screen haionekani. Hope it's now okay. So what is the cost of equity of the delivered farm, kindly? 10 minus 5% of 50 divided by 50.
%15.
15%, thank you. So inakuja hapa 15%. That is the cost of equity. Cost of debt, tuko nayo. It's trading at par, it will be 5%. So therefore the WSEC equals to the weight of equity. Value of equity is 50, the total is 100. So 50 divided by 100 times cost of equity, which is 15. Then plus the weight of debt, the value of debt is also 50. Divided by 100, the total, times the KD. KD is 5. So confirm if we get our 10%. So half of 15 is 7.5, a half of 5 is 2.5. I can see it's 10%.
Mwalimu, mi naomba kusikizia
Number?
kwa skill. Mnaweza share recording.
Ni sawa.
Nipumzike.
Sawa.
Sawa, thank you.
Okay. So that was a confirmation that debt does not affect the value or WSEC. Before debt, the WS was 10%, the value is 100. After debt, the value is 100, the WSEC is still 10%. Witness, you can conclude this question.
Yes, I'm available.
Okay. So number 3, calculate the arbitrage profit, if any, for a shareholder holding 10% of the shares of Kaka Limited. So arbitrage process. So this one, it arises when an investor in undervalued farm, no, in overvalued, not under. An investor in overvalued farm That one is always the levered farm. Sells his investment at a profit and goes to invest in undervalued farm at a cheaper value. So an investor in the overvalued farm sells his investment there and goes to invest in a undervalued farm. So you've invested in the shares that are expensive, sell them, make a profit, go and invest where they are cheaper. So the steps, step number 1, you sell investment in equity of overvalued farm. Number 2, borrow on personal account. Amount of debt equal to investment in overvalued farm. And overvalued farm is always the levered farm. Then step number 3, invest the total amount in undervalued farm and determine arbitrage profit. So what information are we told? Calculate arbitrage profit for a shareholder holding 10% of the shares of Kaka Limited. So you can see Kaka Limited is overvalued. The value is 70 plus 30, 120. So this person has 10% of the shares of Kaka Limited. So first step, he will sell his investment in shares of Kaka. That is 10% of 70 million. So tuanzie hapo. So proceeds from sale of investment in equity of Kaka, that is 10% times 70 million. Which I believe that is 7 million. 7 million. So 10%. So his shareholding in Kaka is 10%. So he sells his investment in Kaka equity. Then he also borrows anything that is there. He has a right to 10% because that is his ownership. He also goes there and borrow 10% of the debt. The debt is 50 million. So we also talk about proceeds from borrowings in Kaka Limited. So he'll also borrow what he controls on the value of debt. Debt is 50 million. So 10% of 50 million, that is 5 million. So I'll have total amount to invest in total. Amount to invest in total. So 5 plus 7, that is 12 million. So I'll take the 12 million and go invest in Papa, not Toto, sorry. Kaka, this is Toto. This is Papa. So look at the gross income. Gross income in Kaka, in Papa, after arbitrage. Then we take amount invested as a fraction of the value of Papa. We multiply by the profit after tax of Papa. So we are investing 12. We divide by, do we have the value of Papa? The value of Papa is 100 million. So divide by 100. And everything we multiply by, do you have the profit after tax of Papa? Tulikuwa na EBIT ya 10 million. Taxes do not exist. Interest is not there. So it's 10 million. So times 10 million. That is
1.2.
1.2 million. So that will be the gross income in Papa after arbitrage. Then we less, tuna appreciate kwa kuna debt alichukua. So less interest on debt. Interest on debt. He had borrowed debt of 5 million and the interest rate on that debt is 5%. 5%. So we less 5% of the value of 5 million. How much is that?
0.25.
So 0.25. So what is the net?
0.925.
So net income in Papa after arbitrage. You're saying
95.
0.95 million. So that is the income that he'll have there. Then we less, we compare it with what he was having in Kaka before arbitrage. So we less net income. Was it Kaka before arbitrage? So before arbitrage, we are looking at, he was owning 10%. So 10% of the profit after tax in Kaka. %10 of the PAT. So you're having 10%. times EBIT ya kaka bado ni 10 million. But huku lazima to less interest. Its EBIT, sorry. Its EBIT is 10 million. Lakini lazima to less interest is 5% of the 50. Ili tupate the profit after tax. EBIT minus 5% of 50. Minus 5% of 50 million. Rana, that becomes ngapi?
Becomes 9.75.
Sorry?
Oh, times 12, no. 0.975.
It is 10%. First of all, malizana na hii. 5% of 50 is how much?
Is 0.25.
10 minus that.
Zero 9.75.
Then times 10%.
0.975.
0.975.
Mm.
0.975. 975. And this 0.95. There's no arbitrage profit here.
No. There's a wrong calculation somewhere.
5% of 50.
2.5.
2.5.
Yeah.
Then
10 minus
2.
2.5.
That is
7.5.
Then 10% of that.
0.75.
0.75. Yeah. So that now you have the arbitrage profit. Yeah, it should be that way. So now we are having 0.95. 0.95 minus 0.75.
0.2.
So shillings 0.2 million. That is our arbitrage profit. Pia formula bado iko mingi.
Tutashika tu.
I think that's okay. I want to identify one question. Alafu ni kuache umalizane na wageni.
Ndata nimejificha tu pahali.
Nao nasikia tu kwa background. They must be wondering, Winnie ameenda wapi?
Nimejificha. Kwa room ingine wako kwa room ingine, niko kwa room ingine. I didn't want to miss class.
Thank you. So I'll identify the question, then I'll share on your WhatsApp.
Okay, no problem.
I'll share on your WhatsApp and